So, hello and good afternoon. I welcome you to today's special webinar, Discover Tactics of Discretionary and Quantitative Pro Traders. Oh, unfortunately, there's still part 2. So today it's already part 3. 1 second. This is something I have to change. So everything else is fine, but okay, so now it's perfect. Yeah, and I'm really happy to be here again, to be host of this webinar exclusively for JFD brokers, and to welcome Stefan Friedrichowski again. Hello, Stefan.
Yeah, hi Jens. Hello everybody. A warm welcome from my end as well. So yeah, be curious. There will be lots to be discussed today. Good results. So you can be curious about those results, and they will give you some more insight in open range breakout strategies like the one Jens introduced last week. So today we will have the statistics behind that strategy in an Excel sheet. And yeah, let's look for the results later. But first, Jens will go with his part.
Yeah, sure. Thanks, Stefan. So I really look forward to those statistics since I mean I for myself know that the strategy works really well with my discretionary approach, but in fact would be very interesting to see how the strategy itself works if you're purely training it, let's say from an automated perspective, or with probably just one filter, like an exponential moving average, where you decide where the advantage can be found. And what I plan to do is we want to have a look. First of all, I just have to. Oh, by the way, I just found out that's probably a good idea to open the MetaTrader right now. So right now I don't have any positions on, and so far, I don't plan to take any positions before the ECB. By the way, just to give you some ideas on my thoughts right now. So probably some of you might have listened to the morning meeting today, where I already gave an idea of how I see the current, especially weakness in the US dollar, but also the euro strength, which is probably the main driver of the DAX weakness. On the other hand, again, here today. And I have a very clear opinion on what I expect. So I don't see the euro rise any further. Probably there will be some kind of squeeze, some kind of blow off or something. But to be honest, I think that on Thursday, Mario Draghi will deliver some very dovish hints in his statement during the press conference. And I could imagine that the euro will reverse aggressively on those comments. Happened several times, and it's also a very, very interesting region here. We're trading right now between 115 and 116, and that means if we now say one of the main reasons for the weakness in the DAX is the strong euro, meaning that the downside potential here in the DAX is probably limited. So I'm not even sure if we make it below 12,300 points, but that's a complete different topic. So just to give you a short insight of what I'm looking right now and why I'm not holding any positions. I don't plan to hold any positions before the ECB. Even though some might say, hey, wouldn't have been a great idea to be short the DAX today. I'm surprised to see this weakness. I didn't expect the DAX to drop below 12,500 points. But today, we don't want to talk about the DAX or the euro, but instead we want to talk about the US market open here. And a strategy I've already presented last week. I'll give some insights on my way to trade the open range breakout here, intraday setup, pure intraday setup, which is aiming to trade the market open here around the not around but the market open in the US market. And yeah, as Stefan already said, then the second part of the agenda will be that we'll give a close look at the details behind the strategy, especially how it performed here in the past from a statistics standpoint, what to expect, probably where to adapt it slightly. But before, I'll give to you, well, 1 second, I'll give to you here the next slide. already you've seen, I've included this compared to last week. This is, by the way, the open range breakout from last week. Some of you might remember that we adapted here the approach a little, and we didn't trade in direction of the overall advantage, which could be found on the long side, but we said, well, probably it makes more sense to trade it from the short side today, so last week today. And in fact, there was also something what I mentioned, and what's definitely right now giving me or making me kind of suspicious here, and I'm not really sure whether it's such a great idea to trade the US equity markets today too, even though, for example, last Friday open range worked out really well again. We pushed to new all-time highs, but right now volatility is so low that we shouldn't expect big moves to happen. That's been the case last Friday. That has been the case last Tuesday. And in fact, the VIX has closed beneath 10 on 4 consecutive days, only once in history before. So just to make sure that we get to the same point, the current market conditions are the calmest ever. So it has never been quieter in the US equities before. That's yeah, it happened several times in the past that the market was quiet. It has never been that quiet as already right now. But we all know how this will end rather sooner than later, and there will be some potential real aggressive moves, probably big volatility spikes for whatever reason. Probably Jackson Hole is causing this at the end of August. Probably it's already starting before. No one really knows what will be the trigger, but I think we'll all agree that one day volatility will pick up again. Even though from a pure technical standpoint, there were several chances to trade the open range breakout, as for example last week. And there was something I mentioned then during this webinar when I said, well, what we need is kind of trigger event, something, I don't know, hitting the wire, and which could then somehow cause some volatility. And you know what? This is exactly what happened that exact day when I formulated the setup, when I said, well, potential setup here could be that we aim for 2,410 on the downside, working with a take profit. This is, by the way, something you should remember when listening to Stefan's Excel ideas here, or his work with Excel on the statistics of this open range breakout a little later in this webinar. But I worked here with this discretionary approach, and I said, well, working with a take profit on the downside, probably around 2,410, but don't be too optimistic for big moves to come. And then, boom, what happened? Donald Trump Jr. Announced that he'll publish some emails on his contacts to the Russians before the election in November last year, that resulted in a short risk-off move. It was really risk-off, but the market pushed lower, and that was in fact exactly what I said. This is something you need for bigger volatility to come, and that was exactly what you couldn't foresee, but what just happened. The market not just went here on the downside, but also triggered the take profit of this approach. And as you can see, worked out really well. So the discretionary approach in this case worked really well, since the market turned around here and nearly closed without any changes to the day. So spot trading here, while you could have profited from this move here on the downside. Something very similar happened then on Friday, not with such an announcement, but with a breakout on the upside in the open range on the long side. I haven't prepared this. Oh, but by the way, that was one of the reasons why I already here. Why I opened the MetaTrader. So here, that was the open range from Friday. That was also a setup I presented to the German audience. I said breakout of this open range, 2,452 on the long side. You put the stop here, 6 points lower below the low. And then, as you can see here, the market pushed aggressively higher. The target I was working with here was around 2,458. So at least to get a risk reward of 1-to-1, probably a little higher than that. And in fact, worked out really well. So the market closed significantly above those highs here. So these are two perfect examples of how the open range breakout could have worked out. So if you look, for example, the day before, that was Thursday, didn't work out at all. So there was no significant break, not on the upside, not on the downside. same thing here on Wednesday. So I took those two examples to show you market environments where it worked out well. Here in those two cases on Wednesday and on Thursday, it didn't work out that well. So it's not that this is the holy grail of intraday trading or something. It's a very simple approach, but it works. And this is something Stefan will show to us. And what I will do now before we'll then switch over to Stefan is I want to present to you this concept here, first of all. So the setup itself, how I define the open range. I define it between 1:30 p.m. and 2:15 p.m. GMT. And then, well, I just look where the advantage is. So what I do most of the time is I work with Dow theory approach, or I look at the market structure. But you can also work within simple moving average or exponential moving average. This is something which Stefan will also show to us, which aggregation here works the best. Yeah, and then trade the break of the open range in direction of the identified advantage, and the stop above, below the high, respectively low of the range. And in fact, now it depends on how you adapt the strategy. So there are several ways to do that. For example, in a trending market environment, it makes sense to trail the stop with an intraday, no, not with intraday, but with a super trend indicator. I'm usually using this. When you have market conditions as last week, range bound, very choppy, sometimes it makes more sense to work with a clear defined take profit level. But this is the discretionary approach. The overall setup here is those 3 points. So first of all, identify the advantage based on, let's say, a simple moving average, exponential moving average, whatever. Define the open range. You can do this. You can automate this within a breakout indicator. If you're interested, please shoot me a mail. So here you have the email address. I can send you this indicator. It's for free. You can also Google it yourself, but sometimes you find several indicators which probably don't get the job done accurately. So just shoot me a mail, and then trade the break of the open range in direction of the identified advantage. So we're trading above the 205-minute SMA, let's say. Then we're trading just the long side. If we're trading below the 205-minute SMA, just trade the short side. That's it. So that's the setup. And so here, the next slide is the discretionary touch. This is, I just want to give you a rough overview, since we here in this webinar will focus on the simple moving average, respectively, the exponential moving average as a trend filter. We're not working with this Dow theory / market structure approach I most of the time use. So what you can do is you can look at the dominating time frame, for example. So if you're trading a 5-minute chart, your dominating time frame is the 1-hour chart. And then we just look at where we trade. So question, accumulation or distribution area. So if we're trading in the accumulation area, that's this, by the way, a German chart. That's a little unfortunate here. Right now, I'm working on changing it. So I'm having an online education course for trading students. And right now, I'm right here in this section. I translated, and I have to translate those charts. I haven't get this done, but I will. Next week, part 4 of this webinar series, I guarantee you will see a chart with an English explanation, even though it's not even difficult here, since Ursachenbereich is the so-called accumulation area, and Wirkungsbereich so-called distribution area. That's all. And if you're trading here in an upward structure or in an upside sequence here, an uptrend on an hourly chart, and you're trading here, and you'll have to find a setup based on the open range. Well, you trade it more aggressively than if we're trading here. That's one of the reasons why I last week, for example, said, hey, let's see whether we probably can find anti-cyclical engagements here, even though we know that on a daily, on an hourly chart, we find the market to be a little extended on the upside. So here's the hourly chart, and what you can see here, obviously, is that the market is obviously in a bullish market environment. And last week, we were trading here. Yeah. So, oh yeah, this is something we have to here. Look at this. So in fact, it's not true. It's not true that we were extended, but it's different. It's a little different here. So we were trading here in this region. I have to cut this out here. And as you can remember, probably, I've argued that way. I said, hey, look at this. We have a sequence. It's a sequence of falling highs. It's not even a sequence of falling lows, which is showing that the market environment is not really trendy at all, but it's more kind of choppy sideways, which is one of the main reasons why we work with a take profit on the downside. And that was what worked out. In fact, right now, I'd say that was pure coincidence that the market just got hit by this news around Donald Trump Jr. and his emails with some Russians here, which pushed the market lower. That was pure coincidence, even though it worked out. And that's also something. If you look at what's going on here, for example, well, what you could say is the market is extended, pushed to new all-time highs yesterday, and is right now trading in a so-called distribution area. So it's not that you accumulate as you would do here right now. So obviously the market pushed higher from here, but it's more kind of it's an distribution area. So here in this region, and also based on the price action we've seen in the European markets so far, I somehow favor the short side, even though I have to add here, we have to make sure that we understand volatility is still very low. So if volatility keeps on being that low, we shouldn't expect huge drops to happen here on the downside. And that's something I'd like to emphasize here, even though, by the way, I have to adapt this here. 1 second. Let's go to the 5-minute time frame. So I haven't changed it yet. So that is from Friday. So here, this is 3:30 p.m. German time or 1:30 p.m. GMT. And now what we'll do here is we have to show the green line is the low from yesterday. The red line is the high from yesterday. And so far, as you can see here, we are obviously trading below the lows from yesterday. So if the market opens in around 10 to 15 minutes here in Wall Street, then, and by the way, that's something I have to change here too. The deep blue line is the close from yesterday. That's 8 p.m. GMT, and the turquoise line will be the spot open. That's something we have to wait for here. And now the thing is, we're trading below the lows from yesterday. So what I right now say is we'll see here in around 10 to 15 minutes a true gap. Probably the S&P will close it. Probably he will retest here the region of the close from yesterday. And then we could try to trade a break here on the downside and probably trade it from an anti-cyclical perspective, even though I'd say today I'm very skeptical. So since the market broke out on the upside last Friday, pushed to new all-time highs yesterday, and somehow I have a very strong feeling that that equities will push higher after, especially Mario Draghi on the ECB, but there's also the chance that the BOJ, for example, on Thursday already in the morning, will give a more dovish stance, or not even a dovish stance, but stand pat here and deliver the status quo, meaning I just don't see equities drop that much, even though volatility is low. So every small rumor or kind of risk aversion could result in a sharp drop here based on the fact that the market is heavily underinsured. But if you ask me for my personal opinion, I'd say I don't see that great chances on the downside. Right now, it's more kind of 55% being on the long side, 45% being short today. So it's a small tendency to the long side. Just let's see how the market opens. So usually I already have a quite clear picture before the market open, but today is it's more like let's just wait and see how the market opens, and probably I'll give you an idea of how I see the market then 15 to 20 minutes after the market open, which, as already said, will be in 10 minutes, and where I see the advantage then, right then. And even then, we don't have a clear open range defined, since therefore we have to wait another hour from now. So we'll give the market some room to develop a structure for the day on a 5-minute time frame, and then based on our advantage, decide on our setup, which is, as already stated here, quite easy one. As already said, define the open range here in this time frame, and then based on Dow theory, respectively, on the 5-minute SMA, for example, well, we could easily include this here in the chart, by the way, and then already identify an advantage. So we can also work with the EMA probably. Why not? So here, and well, we're trading below that, meaning we have to favor the short side today. From this perspective, the short side has to be favored, even though from a discretionary touch, I'd somehow say, well, not sure what to make out of this. So, and at this point, I think it's a perfect time to give Stefan the chance to take over and then show the audience here, well, yeah, how this strategy performs. So some might already be skeptical, which is always a great sign for a trader. Be skeptical, ask questions, even though I think statistics in this case show a clear tendency.
Well, thank you very much, Jens. There's one open question in the chat room, but I think I can clarify that as well. There's always the question, what is the real time, GMT, and so on. To answer that question direct from another perspective, since I don't know the guy who's asking where he lives, it's always the real market open time of the US market. And in Germany, it would be 3:30. In London, it would be 2:30. And strictly speaking, and that's absolutely correct, what has Jens on his slide, that would be 1:30 GMT. And the difference between GMT and London normal time is simply the summertime. So therefore, we have now three different times of three different times of times, but all is meaning the same. And finally, it boils down to the real US market open, which is in 7 minutes. Wherever you live, then I think you know exactly what time frame is traded here. Good. Let me try to get my screen here. Hopefully it works. Maybe Jens, you can say me whether you, everybody would see my slides now.
Yeah, one second. So I have YouTube open here. So usually, one second. So usually it should switch. There's a short delay. Let's just see. So I can see your slide. That's the first thing.
Perfect. So we go back to the open range breakout. And maybe I will mention once again the risk disclaimer that whatever we present here, finally, if you trade it by your own, you trade it definitely on your own risk. I think that's self-explaining and everybody knows that. But at least once in a webinar, we have to say that. But anyhow, we go further into the topic of open range breakout strategies, but before I go really in the Excel sheet, I want to touch a little bit about how to optimize trading strategies, because today is the point that we do something like that. We ask ourselves what time, what EMAs are the right, and so we have to answer the question, how do we realize that we have a good optimized strategy? And that needs a closer view, because you will see profits are not all. We have to look into other key figures as well, and finally build one overall key figure which describes the equity of a strategy just with a single number. And then, of course, I go to the open range breakout and show the results. When we talk about optimizing trading strategies, then, of course, in this case, those don't have any discretionary touch, so no opinion, no overall market situation, which in fact I like, and I use that as well for my own trading. But now we look for a strategy which is really based on fixed routes. So therefore, we don't have any opinion touch, any discretionary touch. So we have fixed rules. That means, of course, that we have to write down those rules, like what is the entry of that strategy, what is the exit. They have to be well described. And in most cases, we have other, I call them now descriptive parameters. In our case here for the open range breakout strategy, it would be the time, like 3:30 or German time, 4:15 German time for the end. That are descriptive parameters, as well as if we have an EMA or whatever. We have maybe our stop loss in this case is well defined already, but we might have to take profit. So we have descriptive parameters, and we would try to figure out which parameters are well suited to give us the best strategy. But now we have the question, what is a good strategy? And if you think a little bit more about that question, immediately you would answer, hey, of course, I want to maximize my profit. That might be the first answer of every trader. I want to have profits, therefore everything runs about profits, and that is all. But think about that every trading strategy, every trading account has a drawdown. That means we have phases. The strategy might not work that well, so our account would go south, and yeah, that is something we don't like. So think about, you have a strategy earning 10,000 euros, but in the meantime, you have losses of maybe 8,000. Would you still call it a good strategy, even having those 10,000 at the end of your consideration? So it's not all about profits. Or let's do it visualize. So now I have a question for you. You see within my chart, and you might answer simply in the chat of that webinar, which equity of those four is the best. So you can number them like here, 1, 2, 3, 4, or you might indicate only the color. So we have a red one here with the highest profits at all. So we start this account with 1,000 euro. Finally, we are close to 5,000 after a little bit more than 1,000 trades. And you see we have other lines here which do not perform that well, like the red one. But now it's the question, which one is the real best of those equities? And you can think about those equities might be different equity curves of our strategy we will have later. And all relate to different descriptive parameters like range times, take profit multipliers, whatever, or even the EMA value. And then it's a question, which one we should choose for our trading setup. And the correct answer, at least from my end here, is my favorite is definitely the equity line number 2. But now the question, why? This line combines all the good things. What do I mean with all the good things? Compared to the red one, it does not have that high profits. Okay, but and the drawdown within that equity is nearly zero. There is a drawdown. Maybe here's the maximum drawdown within that equity curve, but within the red one, they are much higher. So what you can immediately say or conclude here is that we need something like a combination of maximum drawdown and the slope of the equity line. The slope of the red one is nearly double as high as the darker red one here, or even maybe it's a factor of 3. But the drawdown is much lower.
Hello. Oops. Okay, that was the moment when the NSA just found out that Stefan found the holy grail of trading and they hacked their account or his account in this moment. So one second, I'll just, so you can see my chart. Okay. And okay, you can see my chart and you can also hear me. So just 1 second, I'll just try to find out where he is. So if his see, so I can see him here in Skype. He's still online. So obviously he has, or he should have internet here. So oh, Stefan, I can see him here again. That's a good one. Good sign. And now just let's see whether. Okay.
Back?
Yeah. Stefan, hi.
Hi. So can you tell me how many minutes?
You were off or we have? So it's still
no, how many minutes I have been off?
Oh, probably a minute. Probably that.
Oh,
yeah.
Okay. So we just talk about here what is the best equity, and the best equity is a combination of three key figures, and the three key figures are the slope of the equity, which should be high, then the maximum drawdown of the equity, which should be low, and finally, we can define what is called the linearity of any curve, and that can be measured, and the parameter is called R square. And that is even a number you can get out of Excel, and we will have that within the statistics of the open range breakout for S&P 500 as well. So that means if I finally judge any equity, if I want to see how it is really performing, I look to that kind of key figure, and that kind of key figure, that's the last line here within that slide, which is for me called OPTI, is simply the maximum drawdown divided by the slope of the equity divided by this R square, and that number has to be minimized. Because if I want to minimize that number, what does it mean? It means small maximum drawdowns, high slopes for the equity, and R squares close to 1. And that is exactly what I want to have in order to describe an equity of a trading strategy. The reason doing this to have one single key figure is simply because whenever you want to optimize something, you need that single number. It's a little bit like you want to plan a journey from A to B and you don't know how to come from A to B. Yeah, then it's the same kind of question. Is the shortest distance the best one? Is the fastest to come from A to B? Maybe the best one is the one with less fuel consumption, whatever. So therefore, we have to define how we optimize. And in this case, we optimize that key figure number OPTI, and that is maximum drawdown divided by slope of equity, and then divided by this R square. And if I go back to that slide here, then equity number 2 would be the best one even in this number. So let's go back to the open range breakout strategy, because we have to define what are our degrees of freedom, and in principle that we question Jens' trading setup, we might ask, hey, is the range start time of 1:30 GMT the right one? So we might change. The range end time, Jens mentioned like 2:15 GMT, we might change. The stop loss is already well defined. It's always the opposite range side. And of course, we have a take profit multiplier. That is the multiplier to the size of the range. And that is simply the risk reward ratio of our.
Okay. One second. Yeah, I think you can definitely see my screen, right? So not sure what the reason is. And he's back and he's off again. Okay, so we just wait, and there he's again. So we just wait until he takes over the screen. So just let's have a short look here into the market open. So DAX, in fact, dropped even lower, so pushed below 12,400 points here. So the S&P coming in, and we can, by the way, now define already here where the open is. So the open, that was the first tick at 1:30 p.m. GMT here is 2,452. So as you can see here, market slightly dropped lower. That's one simple question here. Why is that? So would you?
Oh, so I'm back again.
Hello.
It's sorry for the technical obstacles we have here. It's a nightmare, but I don't know why. I hope it will now work. But maybe you finish your sentence, Jens.
Yes. So, in fact, here, for example, one question might arise from some. What do? Do you write buy the open if the market opens with a gap lower or gap higher? Do you just buy the open here? In fact, I wait a little, since usually when the spot market opens, some losses, stop losses are triggered here on the downside. That means there's usually a tendency that the market pushes 1, 2, sometimes 3 points lower from the spot open, and that's exactly what happened here again. So right now, probably we are about to stabilize here a little, and then this gap close might occur, pushing us a little higher. Then just let's see whether the market can really make it back into the range of the day before or not. I think this is also something which is now playing a role for the DAX. So the DAX is still very, very weak. That's one main reason, probably the main reason here for that, is because of the strong euro pushing right now to 116, just to give you an idea of that. So if now the US markets come in week 2, I could imagine that this could end very horrible for the DAX, even though I still of the opinion that that there's a good chance that euro will reverse most of those gains here. It's a usual intervention line, let's call it here, in the euro for several years now. And this would mean a more dovish stance of the ECB, which could push the DAX higher. But that's it. Yeah. So, Stefan.
Yeah, I try. Hopefully, I come through up until the end here. Let's see. So my screen should be here again.
Yes.
Okay, hopefully it worked out. Good. So so we know now what to do. We know the different degrees of freedom, range start time, end time, take profit multiplier, and an additional trend filter. And then we can quickly go through an Excel sheet, and let me do it in 2 steps. I will first show you only, because that final Excel sheet is 55 megabyte big. So I do the preparation now in this one here, which starts with prices since the beginning of 2017. Later we will have data from 2010. But just to give you an idea of how such an Excel sheet works. So what we have is we have an EMA, and we have calculated that EMA. Here, in this case, it's an EMA of 50, and I have to tell you that my time frame of my data here is M15, not M5. Simple reason is not to have even more data points, but for the open range between 130 and 215, it doesn't change the picture, because we have then the data to calculate that range. And of course, if we go through that Excel sheet, you will find, okay, we have to build up the range, we have to measure the range. And in this case, what I do here, just that remark here, my range times are not in, let's say, standard times definition. My range times here are minutes after midnight. The simple reason for that is only you can calculate that times better. You can better compare those than any writing like 13.00 and so on. So that's the only reason. But indeed, that means the 930 means the 1:30 GMT, and the 960 means in principle the 2 p.m., not 2:15, but it's the starting time of that M15 candle. So that candle ends at 2:15 or 2:14 and 59 seconds. Therefore, in this case, it looks like I have only one half an hour, but it's exactly like Jens is telling us, we have those 45 minutes. So, and then, yeah, we create all the trades. We have all the filters for long and short, and we only trade into the direction of that EMA. But now let me switch to the results of the big Excel sheet.
Question?
Yeah.
Okay. So now I've seen that you switch it. So the first picture you just shown to the audience was EMA 50, and now it's EMA 10. So it's the filter in yellow. Okay, perfect. Okay.
So now we are in the complete history which I have, and that starts in November 2010. And since I can now change the EMA value, the EMA is on an M15 chart. And finally, what you see here is the equity line for that kind of strategy without any additional opinion. It's everyday trading if the range breaks into the direction of the EMA. And then we have that kind of sequence of, in total, 1,347 trades. And you see, here is my key figure, that Opti. And now I can look what changes do I have within that equity if I change the parameters. But before starting that, I can tell you that one observation out of here doing that calculation is that what turned out to be best is to work without a take profit. If you see here a risk-reward ratio of 100, it simply means it will never be reached. But nevertheless, the trade is always closed at the end of the day. But it turned out if I change that number, for example, to a risk-reward ratio of 3, and then I have to wait, unfortunately, a little bit, because as I told you, we have huge amounts of data here within that Excel sheet, so it always takes a couple of seconds to get the result. And then we can look to the equity once again, now with a risk-reward ratio of 3, and you will see, hopefully in a few seconds, that the equity is getting worse. So
Okay, now it started to get exciting, and unfortunately, he was kicked out again. Um, okay, but what we will do right now is the following. Um, 1 second. So you can see my screen. I hope so. 1 second. I'll just see here. Okay, so that's me. So yeah, okay, now you can definitely see my screen. Um, and what we'll do, we will adapt accordingly to this setup Stefan just presented. So he took, instead of the 200 exponential moving average, 10, which is here, and we are trading on a 50-minute time frame. So obviously we're trading below this exponential moving average 10, meaning that today we definitely favor the short side from this perspective. And what we have to wait for now is wait another 13 minutes. Yeah, 30 minutes nearly. So 50-minute candle to close here. And then based on the open range, which has to be, or which has to show itself. So 1 second, let's go here to the um, click, 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 click. So now I just hope that everything turns out to be fine. Yeah. Let's have a look here. So usually, as you can see, I'm working with 5-minute charts. So right now, this open range has to develop here, and we have to change this exponential moving average. So 1 second, it's exponential. It's 10. So we're using it that way. So obviously you can see it's still the same. And yeah, so what we only have to wait for here is now this open range to show here. So what we, by the way, I'm a little surprised to see no period so far. So usually there should be already some small red lines here, but these lines will rather sooner than later they will appear here. So probably it has something to do with the fact that right now you just can't see it here, and now we have to wait until this candle closes, that we'll then see that here is the low, and in this case here is the high of this range. And yeah, so what we'll then do is trade in direction of the EMA, meaning in this case we'll enter the trade when we trade below this. We'll enter the trade once the market goes lower than here, this low, which is currently lying around 12,000 at 2,452.6. We're going short here, place the stop above the high of the range, and then we just enter the short trade and take out the trade at 10 p.m. German time. So it's 8 p.m. GMT, and in fact that's it. So that's the only thing we have to do, in fact. So what you can already see here is something really interesting. So as you can see, if we just do that and call this a live trading, you would definitely you would be really bored. So, and in fact, profitable trading with an advantage, trading with an edge, and this is exactly what we present to you here in this webinar series, is boring. That's, in fact, it's boring. It's something, when you have clear rules, you just live by them. You just trade them. And this fact, you just say, okay, I have the open range defined, as already said here. So I could adapt this slide here, in fact. So this is my personal strategy. But what we'll do right now is probably something we'll just adapt this here. So this is the same, define open range between 130 to 215. Then we go down here with a 10-15 minute EMA. Okay. These are the aggregations which Stefan just presented. Does this work? Yes, I hope so. Okay, 10 EMA on a 50-minute time frame. And then you trade the break in direction of the identified advantage, meaning you're trading above the 10 EMA on a 50-minute time frame, you're long. You're trading below, you're going short. That's it. So this is the simple setup. You have to stop here. And as you can see here already, I don't need to include this. You can, yeah, probably we have to adapt it a little. No TP for take profit. Close the trade. Oh, yeah. There's the picture. Close the trade at markets close. Now we just whoop. So, okay. So these are the rules. These are the rules of the setup itself. And as you can see, or as you could see, by the way, I screenshotted this because it's always good to be prepared. And on top of that, I could bet that one day probably people will ask me, could you show us some statistics on that? So this is the screenshot from the screen of Stefan here. And as you can see, obviously, this strategy works out really, really, really well. So you have a hit rate of slightly below 50%. I mean, and once again, the strategy itself, it's simple. It's a simple strategy. So it's no rocket science or something, but it comes from being persistent or not. Is persistent the right word? Just 1 second. I just have to look this up. I'm not sure whether this is the right word. Persistent. Yeah, persistent. That's a perfect word. So it comes from profitability in trading comes from being persistent here. And this is a perfect word in this context. So what you can see is Stefan just backtested this strategy back to November 2010. So if you want, he just started out there. And what you can see here is, for example, some very interesting numbers. So let me let's just take them out from here. So you have, for example, you have a hit rate of 47%. You have a loss rate of 53%. So these are the first very important numbers. That's, for example, telling you, well, you can be confident in this trading approach without any big problems. And if you, let's say, face a losing streak of 3 trades, 3 losses in a row, it's no big deal. So you're not start to switch strategies here, but you just say, hey, this is like flipping a coin. And at the end of the day, well, I'm seeing 3 times in a row tails, while I wanted to see heads. Probably have played this with some of your friends, and this happens. It just happens, and it's normal. So you don't need to lose confidence in your trading strategy if 3 times a row you lose or you see tails instead of heads. It's just normal. So the next thing, very interesting number, it's the so-called payoff ratio. I love this number. It's one of my key components in my trading, and it's some of those components I'm teaching my students here. It's the payoff ratio. It's the average winning trade divided by the average losing trade. And what you get here is, as you can see, 1.08 divided by 0.62. 0.62. So you get a payoff ratio. Let's use a calculator here. Stefan, are you back? I can hear you.
I'm back again, yeah, but I see you did a great job because you have a screenshot of my screen. That was great.
I anticipated it.
yeah, sorry. But you're absolutely right. And I see what kind of story you are telling. The win rate is below 50%, but of course the strategy is profitable exactly because of that key figure you introduced here, because the payoff ratio is bigger than 1, and yeah, therefore we have a profitable strategy.
Yeah, and if you want, you can take over here again. I think people love
Oh,
to hear.
I'm nearly done. So I just summarized the setup, and so working with timeframes you have introduced, like 1:30 up to 2:15 GMT time, with an EMA of 10 in an M15 chart works well. It turned out that we can live even without a take profit. But it's always up to anybody's opinion how to finally adopt that kind of trading strategy. But it should, well, it can be one strategy within your trading basket, and yeah, there will others other trading strategies we will introduce next week, for example. So, but this one, as I said, you did a great job, Jens. Perfect strategy, and now it's
Come on.
statistical proven.
Yeah, and as I already told the audience, so in fact, the strategy itself is simple. So it's not a very difficult one. You don't need to be a rocket scientist or something, but it's very, very simple strategy. Even though what's making the strategy profitable is persistency, which means you have to trade it. So you have the idea. If you have a big set of data, you can backtest the strategy. This will build confidence in the strategy itself. And then with some simple mathematical ideas here, so risk and money management should be on a very solid fundament. So it's not just that I call them great market wizards. So I always tell, well, risk and money management is important while not taking it into account when trading the markets. But it's definitely a very, very important aspect in your trading in general. And by the way, based on this, you can start to optimize the trading position size of your trading. For example, there's the Kelly criterion, and I think especially Stefan, as a PhD in physics, knows Mr. Kelly really well. So I think Kelly himself wasn't a physician, but he was a mathematician, right? And he wanted
Yeah.
to optimize the position size and playing blackjack somewhere in the 60s. And this could be a first starting point when you say, well, that was something very interesting you just said about drawdowns. So I think Kelly didn't take drawdowns into account, but just wanted the optimal growth of the equity curve, even though you could start here and someone say, well, I'm trading a private account. I want to diversify my portfolio. I want to be a little more aggressive with my intraday trading. And then probably start here and probably increase the position size based on the mathematical input you just get out of these numbers. So you can easily put this here in a formula, which is, by the way, now I have to think. I think it's the hit rate. It's in this case 4.7, and then you subtract by 1.74. I think this is the formula, and what you'll get now is 1.3 divided by 1.74, 0.3. So you get 0.4 minus 0.3. So now, in fact, I mean, risking 70% of your trading equity is ridiculous, but you can easily start to play a little with this. I mean, you can now say I divide it by 2. I still get if I have half the volatility in my equity curve, I still get 3/4 of the optimal capital growth. I think you can just work with the square root here, and at the end you will probably see. Let's by the way, let's do this. I mean, I love it. So we divide it by 2, 17%. So we go down to 8.5%, still too much. But now we take the square root. So this will look a little weird now, but I'm working with the editor here, so I hope I'm taking a square root out of this. And then you'll see, 1 second. Yeah, now you're at 2.9%, for example. still huge. I mean, if you take into account drawdowns here and maximal drawdown, well, you can definitely see that risking 2.9% of your equity is still huge chunk. It's big.
Yeah,
But
I would not go for those big numbers. What I would always prefer is to have a diversified portfolio finally. So looking for different trading setups and still leaving not too much risk in a single strategy, even knowing that if you have a diversified portfolio, the probability that all single strategies have simultaneously the drawdown, but at least in principle it's possible. And since it is possible, I would still go not far above the 1% rule, maybe 1.5, but not more. Just take another strategy. That's a better idea.
yeah, I love that. Yes, so that was, by the way, purely theoretical, but you can see you can play with those numbers. So it's not just pure a theoretical input you might get somewhere. If in the morning meetings or in a webinar you might have seen somewhere, or you've read an article, but you can really play with those numbers. But, and this is, I think, the most important thing here, you only have those numbers if you did all the work which Stefan just did for us, giving us a real clear idea of how big is the hit rate, what's the loss rate here, what's the payoff ratio, do we have a positive expected value, can we expect to make money out of this still simple strategy? And if you have an answer to all these questions, I mean, you're very well ahead of the pack, I have to say. So if you did all this, what we just did here in 1 hour, and you trade this approach, I bet you're ahead of 99% of the people out there, traders out there, and have a good chance to at least break even with your trading, if not come out ahead. I think that's not such a bad outlook.
I can only agree. So we have introduced quite well strategy here, and hopefully you join us next week once again for the next strategy. I will present another strategy on the index DAX. It's a trend following strategy, and you will see good results as well. And hopefully we see each other next week once again. So that's from my end.
Yeah, well, yes, exactly what Stefan just said. I hope that we'll see each other again next week, and hope that you enjoyed our a small presentation here. And if you have any further questions, please shoot us a mail. So my email address here, but if Stefan wants to give his email address too, I think
it has been on my slides. I can repeat it. I know it's quite complicated. It's always just Google my name, then you will find my email address. But it's s.friedrichowski, and that is a really complicated part. But you will find it S. So yeah, you can write it down there. S.friedrichowski, which is really complicated, at jfdbrokers.com.
Brokers.com. So here
exactly.
You can see it.
So that's my email, you can send me an email whenever you like, and share ideas, get questions, get answers. So that works.
Okay, perfect. Thanks a lot, and talk to you again next week. I look forward to it.
Yeah. See you. Bye-bye.
See you. Bye-bye.